as are the expenses, mortgage, insurance, taxes, property management, everything's built into this. So then we can see not just our cash balance for the asset, but also our monthly P&L. And we can see where we land from a cash flow standpoint that way. So these are the financial model that we use when looking at a multi, and there's 3 tiers to this. It starts at the most macro tier to be very, very fast. And 2 steps are involved in this. One, we grab the raw financials that are provided by the sellers to be used, but never to be assumed to be accurate. From those, we're able to very quickly assess what's our estimated gross increase in revenue, not just in the unit rents, but across the building itself, and then price per door. If that starts to look interesting, and that's a very, very quick exercise, if that starts to look interesting, then it's time to start looking into more detail. That's when we get into this model here. This model has the NOI cap rates all built out for current state, has the same thing built out for future state. All that is built, let me just show you here, from a rent roll that shows, again, current and future state, aggregated up to monthly and yearly. All that is brought into this analysis. That gives us our purchase cap rate, gives us our refi cap rate, gives us the NOI uptick, and maps all of that into a monthly P&L and forecasts for ROI and future revenue. Now, if that starts to look interesting, then we use a more sophisticated model from there. Really what we're looking at here is a 4-phased model where we can see, phase 1 of stabilization, phase 2. Each phase can be anywhere between 1 and 60 months long. When that duration is captured, it gets displayed up here for the phase title. We have our financing all rolled in. It can be interest only, it can be P&I, both. The P&L for each phase is captured, as is the refi scenario, as is the 5-year projections from that point in time forward 5 years. So each phase you can look at the 5-year. And then we have a DCR calculation down here as well, so that we can see exactly, because if and when we refi, we want to be able to look at it ideally first from a DCR standpoint, because that's where the lenders are really looking at it. And secondly, from an LTV, we heavily weight the DCR because that's really what it's going to be based on. And we can do that for each of the 4 phases. And then that is aggregated up into a summary where we can see the capital involved at each phase and the rent roll for each phase, how it increases over time. Do we use a 2% blended increase across natural turnover? Everything is built in there. And so this is our third and more detailed, more sophisticated model to be able to vet these buildings, so we can really actually see what is this thing going to look like over the next 5-10 years on a projected basis. Where are we really going to land? Then we have another model that we've built out for operating the building. And you can see here, we've got current rents, 3-year projected, 5-year projected in terms of where we're going to land. The whole rent roll is built out in this whole model here. And that spans out right out to 2037. So 15 years from now is how long that rent roll model is built for. We can see the gross rents. We can see the breakdown of expenses throughout that entire thing. And then I can also model in down here, all this blue is where we would input data. I can model in when exactly how my rents are going to be increased. That picks up in the entire thing. And now we can see in the operational model, that rent then gets rolled up into this rolling P&L that we have. Gross revenue is captured here, so every time there's an increase, we can see it hitting that P&L, as are the expenses, mortgage, insurance, taxes, property management, everything's built into this. So then we can see not just our cash balance for the asset, but also our monthly P&L, and we can see where we land from a cash flow standpoint that way. Then we can also look at investor capital, and then again, the same thing here. I can see the NOI rolling month over month through the entire 15-year period. I can also see where could I refi, where's my DCR sitting at month by month for every single month of those 15 years, so I can see exactly where am I going to land if and when I were to refi, when can I refi, and for how much based on the DCR. And that's really, really important, right? We want the most accurate model we can over that 15-year time period that we can possibly have. And then I can also see some trend graphs, right? So what's going on with my NOI over time? How do I project that to go over the life of the asset? And so that's a bit of an overview of the financials that we create here and why we create them. Each model has its own use. It starts very, very fast, meaning it starts fast from a model standpoint. It's very, very quick to run that price per door and NOI uptick percentage to see if there's more interest. Then we run tier 2, which is also fairly quick but a little more time intensive, and then tier 3 where we get a very more accurate picture, and then we build out the operating model for it. So a little bit of insight in terms of how these models are built and what each one of them produces. So I hope that helps.